Lesson 27 is IPOs are highly speculative, so don't mess with IPOs, guys. Don't mess with IPOs. IPOs is an initial public offering, which basically is a situation that, let's say, I'm here and I've got my business, okay? I've got my big business I've created and I want to take it public. I want it to be on the stock market exchanges and whatnot. I want to sell out some of my shares. Some of the other investors want to sell out some of their shares. We want to go public with this company, okay? And raise more capital and all that kind of stuff, okay? So basically that's what we do, and we go public, okay? We just put GP, go public, and that's an IPO. That's an IPO in its simplest form right there. I got a private business I created that's become a pretty big business, and I want to sell out some of my shares. The other investors in that business want to sell out some of their shares, and you know, we just want to go public at this time. We want to raise more capital on a big scale like that, okay? That's main reason to really go public at the end of the day. Now, the problem with IPO investing, the problem with buying IPOs is when you buy into a company that just went IPO, when I mean like just buy into it, I mean like buy within like the first year of that company going public. When you do that, you're generally buying an overvalued company, okay? A company that at worst case scenario is already fairly valued, but in most instances, it's actually an overvalued company, okay? It's usually overvalued. Why is this? Why is it an overvalued price? Well, okay, there's me. I own my big business, right? Would I really be interested in taking this business public for any other reason other than to sell it for probably an overpriced valuation? Probably not. Let's think about it. As a private company, my life is much less stressful, okay? When you go into the public markets, all of a sudden you have all these investors who always want, you know, their stock to go up, and if it goes down, they're calling for your head, and this and that is so much stress on your shoulders. Why would I want that? Why would I not just want to stay a private company? Also, when you go public, all the information is public out there. Everything's public. Anything that's went on in your private life becomes exposed. Everything gets out there when you go public, man. Everything, okay? Your wife, your kids, I don't care what it is. When you take a company public, everything's out there. So you're gonna tell me I'm gonna give away my privacy, I'm gonna make my life more stressful for this, okay? And on top of that, you're gonna tell me I'm not gonna try to get a ton of money from this? I'm not gonna try to get a ton of money? Like, it's just unrealistic, guys. Never mind that, I could say, well, I could just stay private, and if I really wanted to raise some more capital, I could do so in the private market, really. I just go in the private market. There's tons of, you know, venture capital funds and whatnot that invest in companies, you know, and you know, take out stakes in the companies. And so I could just sell out some of my shares there. Most of the time why they do it is because they want to sell it for an overpriced valuation, okay? The investment bankers, okay? And there's another big piece down here. It's the investment banks, okay? Investment banks. We're talking about Goldman Sachs. We're talking about, you know, big banks like JP Morgan, you know, Wells Fargo, all those type of banks, Barclays. All those type of banks, they're usually in on the IPO process, okay? Morgan Stanley, these companies are all in on the IPO process, right? They all get a cut of however much money that company goes public for, okay? So the higher this number is, the bigger the valuation, the more money these investment bankers get, okay? Not only do these guys get more money, the people that started the business and were early investors, not only do they get more money if it's a higher price valuation, but the investment bankers, they all make more money, okay? So it's pretty simple. They want to sell out for an overpriced valuation. They want to get the most money they can for that business. If the business is fairly priced at, let's say, $10 billion, let's say the fair price for that business would be, you know, $10 billion. Yeah, you know what these guys are going to want to sell for? They're going to want to sell it for 15 to 20 billion. That's what they really want for this company, okay? And they're going to talk it up, and they're going to talk about, oh, they got so much growth going for them in the future and this and that and all these things, right? They're going to talk it up like crazy because they want to get that super high price, okay? Otherwise, it makes no sense, guys. It literally makes no sense. From the business, think about yourself in the business owner's perspective. You create this big business, it's successful, you have a life that's, you know, probably still stressful, but it's not nearly as stressful as if you're a public company. You don't want all your, you know, family life and everything exposed, which when you go public, that's all going to get out there. All that information's out there. Everything becomes public. All the numbers you're doing or not doing are going to become public. Your net worth is going to become public. Everything's going to become public. You're going to tell me you're going to do that for any other reason other than to sell out for an overpriced valuation? Doesn't make sense, guys. That's why you don't want to invest in IPOs. Yes, sometimes do they go up like crazy? Yeah, sometimes. But that just means they just probably went more overpriced, guys. And there's a lot of times where they've gone down massively, okay? You can look at a ton of IPOs that they go public and their stock just takes a big poop. Or maybe it goes up initially the first few months and then it takes a big poop, guys, because people start figuring out, well, this company is way overvalued. This company is really only worth $1 billion, but yet it has a $3.3 billion valuation on it. People start figuring that out and they're like, whoa, this is crazy, guys. So don't mess with IPOs, highly speculative. And I'm not a speculation investor. I don't, you know, especially not in a big way at all. Like, I don't mess with these spec type companies, these ones that just went public. They don't have proven track records. Everything was in the private. You don't know exactly what was going on when they were a private company, what their execution was and all those type of things. A lot of that information is all private. You don't know. You maybe know the financial numbers they were doing the last few years, but you don't know exactly the execution and what employee left and this and that and all the stuff behind it and how many failures that they had. You don't really know that type of stuff, guys, because they were a private company back then. They got no track record. You're going to invest in a company that's got no track record as a public company? Sounds pretty risky. You're going to invest in a company that the investment bankers and the business owners and the early investors are probably selling for an overpriced valuation. Sounds risky, guys. That's risky. And we just talked in the last one about margin and preserving capital. Another big thing is preserving capital through IPOs. Like guys, you know, you're investing in IPOs, highly risky. That's all I'm going to say. Highly speculative if you're messing with them. So anyways, I hope you guys enjoyed this. I hope you learned a lot and got a lot of value from this lesson. Let's get on to lesson 28.